Have we finally reached the end of the Fed raising interest rates? Today we're discussing interest rates, the Fed, and the impact they've had on gold, silver, and other precious metals. So, the Fed met on May 2nd and 3rd and raised interest rates by another 25 basis points, or 0.25%. This puts the Fed funds rate between 5 and 5.25%. Now, the Fed funds rate is the rate at which banks lend money to each other. And of course, this means the rates at which banks lend money to consumers and businesses also rises. Today, if you're trying to get a 30-year fixed mortgage, you can expect to see a rate between 6.5% and 8%. Now compare that to just a few years ago when we were getting mortgages under 3%. We're going to get into how this all affects gold and silver and platinum. But first, we need to explain why the Fed is doing this, and then we'll get into why we care. First, the Fed has been raising rates to fight inflation. Turns out that handing several $100 billion in free money to people does actually result in inflation. Who would have guessed? The Fed was a bit slow to come to the table and recognize it as something substantial, but with an attitude of better late than never, they began raising rates to tamp down on inflation. We won't get into whether we think that's effective or not, but we will talk about the real effects it has on markets and on gold and silver. Now keep in mind as we're talking about this that interest rates have varied effects on many systems. Some of those effects are easy to predict and some are less. For example, the Fed raised rates so much and so quickly that banks were unable to adjust their portfolios to keep up with the changes. This has directly caused some of the bank failures we've witnessed in the US. Normally, interest rate hikes occur modestly over a long period of time, and that gives bankers the runway they need to adjust their portfolios for risk. It also gives regulators the time they need to perform their oversight and prevent banks from accruing undue risk. So what happened to gold when banks began to fail? Well, gold was trading around $18.50 an ounce. It's now over $2,000 an ounce. Silver was trading between $20 and $22 an ounce prior to March 10th when the bank failure occurred, and it's been consistently trading over $25 an ounce since then. So this is an example of something that's difficult to predict. Sudden interest rate increases causing systemic risk. Other variables that are more predictable involve the effect on real interest rates and the value of the dollar. Since the Fed began raising rates, the greenback's value has gone up, and gold has an inverse correlation with the US dollar. Now, if you're not sure what that means, just go to our gold price page, set a 5-year range on gold, and select US dollar to add a trend line to the chart. You'll see a pronounced effect leading up to September 2022, where the US dollar increased in value and gold decreased in response. Now, the Fed began raising rates on March 16th, 2022, and it was within a few months that gold had started its decline. Do the same comparison to silver on our price pages and you'll see the effect is still there somewhat. But it seems more likely that silver's reacting to the price of gold rather than the dollar. Silver does tend to follow gold. Gold is impacted by more than just the value of the dollar, though. It's often cited as a hedge against inflation. And that's true, but it's not simple. Gold does not tend to correlate well with inflation, but it does correlate well with real interest rates, of which inflation is a component. Real interest rates are the current interest rates minus the inflationary rate. Gold is negatively correlated with real interest rates the same way it is negatively correlated with a dollar. And gold tends to perform at its best when real interest rates are negative. All of this starts to make a whole lot of sense when you consider that gold is a non-interest-bearing asset. Gold doesn't pay dividends. Gold doesn't pay interest, and neither do the other precious metals. So if you're an investor making money off the interest your investments generate, you probably don't want to put a lot of money into gold when rates are high and inflation is low. However, when rates begin to drop and there are negative real interest rates, gold becomes much cheaper to hold, and a better safeguard against the corroding effect of inflation. Gold is therefore much more attractive to an investor or a central bank if negative real interest rates are a concern. So think about that for a moment. If negative real interest rates cause gold to perform better and the Fed begins raising rates and real interest rates creep towards turning positive, what happens to gold? Let's sum up real quick what we just covered, because it was a lot. The Fed has been raising rates and the US dollar has felt the impact, as has silver and gold. Silver seems to be following gold's lead, as it frequently does. Gold initially reacted to raising rates and a stronger US dollar by pricing down, going as low as about $16.30 an ounce last September, give or take a few dollars. At the same time, real interest rates began improving, which also has the effect of tamping down on the price of gold. Then, a bank run caused a financial panic and spurred a huge influx of money into metals as a preservation tool, and voila. You have a cocktail of price movements caused, in part, by the Fed raising interest rates. In some cases, the Fed raising rates lowers the value of metals for the reasons we just stated, but when they introduce systemic risk, it can produce the opposite effect. This is a big reason why gold has experienced incredible demand, but has not yet taken off to set new all-time highs. But that's the big news. Market watchers are celebrating this last interest rate hike because it's believed to be the last one. Now, I want to preface this with a healthy dollop of skepticism. No one knows what's going through Jerome Powell's head except, hopefully, Jerome Powell. That said, statements at the last Fed meeting were dovish and did seem to indicate that we would be pausing interest rate hikes. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.